Hi, this is James Orr, and welcome to the Real Estate Financial Planner Inside the Numbers podcast. This is episode 1. So, in this episode, Andrea's story was she was recently divorced, has 2 young kids, aged 4 and 2. She was able to walk away with $100,000 as her share of the proceeds after the divorce. And she's trying to live her life as an accountant working for a small manufacturing company while she is providing for her children and using the $100,000 that she walked away with from the divorce to save for retirement and be prepared to save her money that way and be ready to go. So, as part of the inside the numbers, we really want to jump in and understand exactly how this scenario is set up so that you can copy it to your own account, make any modifications you want to, and have it better reflect your situation or the situation of someone that you're trying to model. So, I'm just going to click right into the scenario itself, and I'm going to start walking through what the assumptions were that we used it. And then you can see where you'd want to modify something in order to be able to do that. Okay, so the scenario name, we basically just named it this. If we put anything in brackets, it's going to become like this little red. For example, EP1, you can see how it shows up there. So anything you put into brackets like that is going to show up that way. And then we just named it as Andrea baseline. So you can name it whatever. It doesn't actually get used anywhere. It's only for you selecting what it is on there. We ran this scenario for 480 months. You can do up to, I believe, 720 months on the system, but we're just doing 480 months, which is 40 years to model it out. And in most cases, since she's 40 years old, that's going to model her out through age 80 in this particular case. You can put the name of the person, name of person 1 and person 2 in this situation, and their birth dates. We didn't do this in this particular case. It's completely optional. And right now, the software doesn't do anything in particular with it. Eventually, I want to be able to make it so that it shows you your age on charts, but that's not done yet. The effective income tax rate. So we've set the effective income tax rate to be 15% here. If you were really doing this modeling for yourself, you'd want to go, click on the link for smartasset.com and look up like what your estimated effective income tax rate would be for you and put that in here. This is primarily used when we determine what the depreciation benefit is for someone. And so we put in 15% here for her effective income tax rate. If it's higher, it's going to be less conservative. If it's lower, it's going to be more conservative. So we kept it at 15% to be relatively conservative in our estimate as to what the tax benefit, the depreciation tax benefit for her of owning the rental properties are. The inflation rate, we've set the inflation rate to be 3%. So that's why we have that 3.000. And that means that things become more expensive over time at a rate of 3%. The mortgage interest rate, 4.875 is what we've used here. This only gets used in the case of a cash out refinance. The actual mortgage interest rate we'll find out on the individual properties because each property can have its own mortgage interest rate. So we'll use that there. Minimum target monthly income in retirement, the MTMIR. In this case, Andrea is making $48,000 a year, about $4,000 a month. So her minimum target monthly income in retirement is going to be that same $4,000 a month. We really want to get to the point where the amount of money she has coming in replaces the income she is earning from that accounting job. And so we've set her minimum target monthly income retirement to $4,000 right there. And then we've set her ideal monthly income retirement to $20,000. This is sort of like her living her ideal lifestyle. And honestly, it's probably a little bit high. So you can adjust that. And really, this is used in when we determine if somebody has achieved financial independence. We're using that minimum target monthly income in order to do that. And also, we're going to use the ideal to tell you on a chart when she reaches her ideal target monthly income retirement, the ITMIR, for her retirement there too. And then here we have an option whether we adjust the minimum target monthly income retirement or the ideal target monthly income retirement when her owner occupant property, the property that she is living in, has its mortgage paid off. So you could either choose to, yes, go ahead and adjust that number down so she doesn't need to earn as much once she has hit her number if she is paid off her mortgage. The way to think about this is if you need $4,000 a month in order to live a comfortable lifestyle, to be financially independent, and that includes a mortgage payment. Well, when you pay your mortgage off, you no longer really need $4,000 a month. You need $4,000 minus whatever your then current mortgage payment was in order to be able to live there. So you can decide whether you want to adjust that or to leave it on. In this particular case, we've decided to adjust it down when she finally does pay off that mortgage And that way, if she pays off her mortgage before she hits financial independence, her target to be able to reach financial independence is lower. If she reaches it after, it just means her lifestyle is a little bit higher because she no longer has that mortgage payment. A yearly safe withdrawal rate. In this case, we've used 4%. It's kind of like the 4% safe withdrawal rule, if you've kind of heard of that before. And so in this case, we've said, hey, look, if any money she has in her bank accounts, we're saying that she can safely withdraw 4% per year, and that will give her her ability to achieve financial independence. It's one of the metrics, one of the inputs used in order to determine whether or not she's reached her financial independence number or not. And so we've used 4% here for that. Then the scenario description, this is off just for you to keep notes. We've kind of written out a little bit of what her situation is, just so we have it all here and you can see it. But you're welcome to put whatever notes you have in here. So if you're kind of making a copy of this and you want to change it, you can put in what your notes about this particular scenario is for you. In this case, we're not running Monte Carlo. You may not have access to the Monte Carlo situation on your software package, but we're running only one of these things, and we're running with static numbers anyway. The advanced version of the Real Estate Financial Planner podcast does Monte Carlo simulations and models what happens if the inflation is variable, or her appreciation rate on her homes are variable, or the rent appreciation is variable, or the mortgage interest rates change over time. And then since all those are variable and can change over time, we want to run it more than once to see what the range of values are for when she hits her financial independence number and how much cash flow she has and how much money she's making. So we do those with using Monte Carlo. In this case, we're only using one because we're not going to do anything other than static assumptions for all those. You can determine whether or not you want to be able to share this scenario with anyone. You can basically do it so that anyone can use it as long as they have the link, or anyone you share a special link with basically has a password in the link itself, or if only you want access to it, you can set that up there. In this case, because we're making this as a public podcast and we want people to be able to copy her scenario, we go ahead and set it to be anyone. If you are copying it to yourself, you probably want to make it only you, or anyone with a link if you're going to share it with someone else. And then these would be the links in order to share with people if you were sharing it with other people. Okay, so now let's talk about accounts. Every particular scenario that gets set up has a default cash account. The default cash account is the account that gets used if you ever have your regular bank account go below zero. So you can't have a bank account typically go below zero. So in those cases, we actually go and we hit the default cash account. That account can go negative, and then we have to see how much money outside of the system you had to bring in order to make this work. In this particular case, she has an all-in-one bank account to start with, and so I'm going to click through to kind of see what the assumptions are on that, and then we'll go ahead and see how that all works out there. So basically, this is her bank account that we set up. I'm calling it the all-in-one account really because we didn't make a separate checking account or separate savings account or a separate account for her stock market. We basically just put it into this kind of hybrid all-in-one fictitious account. And that account, we have $100,000 that she starts with. It's the amount of money she walked away with from the divorce. And we're saying she's earning about 8% per year in that account. Now, that's sort of like a stock market rate of return. It's completely hypothetical and it's fixed. So it doesn't actually change over time. In the advanced versions, we actually change this yearly rate of return to be variable to kind of model what the stock market might actually do. But in this case, we've decided, hey, look, it's going to be 8%. It's going to be fixed there. And we're doing that. And we didn't say, hey, look, she really keeps $5,000 in her checking account that's really earning 0% or 1%. And then she's got, $95,000 in the stock market and that's earning 8.5 or 8.7 or whatever it really is. We just said, look, we're just going to, as for simplification reasons, we're going to stick it all into one account and keep it all there. And so that account starts with $100,000 as shown here in opening balance, and the yearly rate of return is 8%. And we're saying that it's a stock type of account. You could choose whatever really she has in these accounts, but in this case, we're saying it's stocks. And that gets used primarily when we start looking at kind of her asset allocation, how much she has in stocks versus how much she has in bonds versus how much she has in real estate. And so really, it just shows you what you have in those accounts there. All right, let's go back. All right, so we've set up the accounts. You show that those are there. And you have to make sure that when you're setting this up, you have all the accounts added to the scenario. So if you had accounts that you had made that you had not added, they would show up down here. And you need to make sure that they're showing up as green, that they're included in the accounts. Now let's look at the property. In this case, we have a typical rental property. It's a template of a property here. Let's go through whatever the assumptions we use for that. So we look at this, you can see at a glance how the cash flow is in this property using the cash flow power meter. We have entire classes separately on what the cash flow power meter is, but it basically shows you at a quick glance how well this property is cash flowing. And that shows that it's in this light green area. It means that it has positive cash flow if she was managing it herself. If it's in this dark green area, it shows that she has positive cash flow if she had a property manager. If it's in this yellow area, it shows that she doesn't have positive cash flow. But when you take into account the cash flow from depreciation, the tax benefits of owning the rental property, then it's positive. And anything in the red area over here shows that you have negative cash flow, that it's not even making up enough to cover the amount of principal paid out. And anything over here shows that she has negative cash flow, and it's even not making up for the amount in principal that's being paid there. So the fact that the little black line is right here above the green one shows that it's very slightly positive, assuming she's managing it herself. It's a dynamic property, which means that it's a property template that we're able to buy more than one of these properties using rules. If it's something that she already owned, like she already owns 1234 Main Street, we would have used already owned here. In this case, you're using a template to do that. And it's a nomad property. And remember, the nomad strategy is when you buy a property, as an owner occupant, so you have to move into the property. You move in there, you live there for at least a year. It's a requirement of the lender. When you sign for your loan documents, you're agreeing that you will owner occupy the property for 1 year. It's what the agreement is with your lender. And then after a year, you can convert that property to a rental, move out of it, you buy another property or rent another property if you want to do that. In this case, she's going to be buying a property and moving into it, and you convert that previous one to a rental property. So that's what the nomad property does. It basically says, hey, look, I'm going to live in this property for a year. Once a year is up, if I buy another property that I'm moving into, I want to convert that old one to a rental. And so we have a little toggle button for that. It shows that that is on for doing this. So the address or description, we're calling this just typical rental property. That's what we're calling it. And so they'll be numbered typical rental property 1, 2, 3, 4, 5, 6, 7, 8, 9 as we buy different ones. The city, in this case, we didn't list the city here. You put in whatever city you want there. It's not really used for anything. It's just for you keeping track of where it is. No state in this particular case. The zip code, we didn't put a zip code in there. And the after repair value, so after repair value and the purchase price are the same. So she's buying these properties for basically what they're worth. She's not getting a discount on them. She's not paying a premium. And in this case, she's buying $250,000 properties for $250,000. So the after repair value is $250K and the purchase price is $250K as well. Now here's that mortgage interest rate. So she's able to get 3.125% interest rate on this mortgage on this particular property. And that's a 30-year fixed rate loan. And then for the mortgage term, 360 months. So that's a 30-year loan. If you were doing like a 15-year mortgage or something like that, you could put in 180 months there and have that change as well. In this case, she's putting 5% down. She's not using a separate dollar amount. You could say, hey, look, I've got not 5% down. I've got $20,000 that I want to put down. You could decide to do $20,000 instead. In this case, she's just doing 5% down on the property. That means her loan amount is going to be $237.5. It's calculated for you. And the monthly payment on that is going to be $1,017.39. Her principal, interest, taxes, and insurance is going to be $1,236.14. That's calculated. The principal, interest, taxes, and insurance, that's PITI, plus the HOA, plus any PMI she's going to have, the private mortgage insurance on the property, is going to be $1,394.47. In this case, because she put 5% down, she's going to have private mortgage insurance, and that is actually worked out to be 0.8%, not 1%, but 0.8% of the balance of the loan when she first takes it out per year on that property until the balance of the loan and the property value makes it such that the loan is less than 80% loan to value. And then at that point, the private mortgage insurance will go away. So in this case, the private mortgage insurance is $158.33 per month. And then for closing costs, we're saying that the closing costs that she's going to be charged by her lender in order to be able to get this loan and to be able to close on the property is 1% of the purchase price. So about $2,500 in this particular case to do that. This property is in really good condition. It doesn't require anything to get it ready to rent because she's going to be living in there for a year anyway. And so we don't have anything in here for rent ready costs. But if you had a property that you knew you were going to need to do work on, you could put a dollar amount in there for what it is for rent ready costs. She's not able to get the seller to agree to pay for any of her closing costs. So seller concessions is zero, both for the dollar amount or for the percent. And then in this case, the depreciation assumptions, we're saying that about 15% of the property value is considered the value of the land. because you can't depreciate the value of the land. You can only depreciate the value of the building for tax reasons. And so we want to know what percentage of the property is considered the building and what percentage is considered the land. In this case, we said it's a residential property and 15% of it is the value of the land. And so we walk you through how we did the calculation in order to determine what the depreciation benefit will be. The accounts show where's she getting this down payment from? She's getting it from that $100,000 all-in-one account. And then where are we depositing any rents that come in, and where are we taking out the mortgage and the taxes and the insurance? We're all doing that out of the all-in-one account as well. You could, in theory, actually set up the scenario so that you're pulling down payments out of one special account, and then you've got all the income and expenses going into another account and coming out of the other account. In this case, we've just done them all together. We're saying property values are going up 2% a year. So that means that any properties she owns are going up 2% a year, and the properties that she's going to be buying in the future, kind of like the template we're using, that is going to be moving away from her as she gets further down there at a rate of 2% per year. So that $250,000 property is going up at this appreciation rate of 2% per year. Okay, we're going to start the rents. We're going to start it as soon as we're done moving out of it after a year. And the rent on the property that she's able to get on a $250,000 property in her market, she's able to collect around $1,600 a month in rent. And we're saying that rents are going up at a rate of 3% per year, which is keeping pace with inflation. So property values are going up 2% in this case. Rents are going up 3%. That's a little unusual for what I'd like to do. Typically, I'd like to have rents and appreciation going up at the same rate. But in this case, she's in a market where the property rents are going up a little faster than property prices. She's getting no other income on the property, and that other income is not increasing at a different rate. So she could be saying, look, I'm getting, an extra $50 a month for renting out the back storage shed, or I'm charging them extra for utilities or for internet service or something like that. And you could have a separate appreciation rate for that other monthly income. In this case, she's not doing either of those. She has no other monthly income, and it's not going up at an increased amount. So let me show you monthly gross potential income. It's $1,600 a month plus the $0 for other income. So it's $1,600 a month, and that's really just the rent. The vacancy rate, so we're saying that it is vacant 3% of the time, which means that about 1 month out of every 3 years. Now, if you do property management the way we typically suggest, you will be trying to find a replacement tenant at least 60 days prior to the lease expiring. And so you should have very low vacancy rate. You should have sub 3%. And if you've got a higher vacancy rate than 3% because you're having a hard time finding a tenant, then you're probably priced a little bit too high for that particular market at that time. And so we try to target around 3% for our vacancy rate, but go ahead and make adjustments for whatever you believe to be true is in your market and your kind of management philosophy. So monthly gross operating income is that gross potential income minus whatever your vacancy rate is. So in this case, our monthly gross operating income on this property is $1,552 per month. Property taxes, we're estimating it's about 0.65%. It happens to be what the tax rate is in my particular market. I know in other markets that seems really high or really low, and so it works out to be about $1,625 per year, or $135 per month, and that does increase as the property value goes up because it's a percentage of the property value, which is typically how taxes are calculated. Then as property values get more expensive, the taxes on that are also going to increase as well. Property insurance, we're using 0.4% per year. And so that's estimated about $1,000 per year, about $83.33 per month. And again, because that is a percentage of the property value, then the amount that insurance costs typically goes up each year as property values get increased, which makes sense. I mean, it costs more to insure a more expensive property. And so as property values go up, the cost to insure them should go up as well. The yearly HOA, there's no HOA on this particular property, so it's $0. The HOA appreciation rate, if we had an HOA, the appreciation rate would show how fast HOA costs are going up in that particular property. Are you paying any monthly utilities when you rent the property out? And in this case, the tenant is paying for all the electric and gas and all the other utilities that they have on the property. And so the landlord is not paying any. So it's $0 here for monthly utilities. And then you have a utilities appreciation rate. If you think that's going to go up faster or slower than inflation, you can adjust that independently as well. And then if you have any other monthly expenses on a property, you'd use those here for other monthly expenses, 1 or 2. So for example, if you're buying a triplex and you are responsible as the landlord for maintaining a common area or for mowing the lawn in the front of the houses or something like that, you can add a separate monthly expense in for those and a monthly expense appreciation rate. And we've got room for 2. If you have more than 2, just combine them into 1 and put them in there. In this case, We have no separate additional monthly expenses for either one or two on this particular case for Andrea. Maintenance on the property, we set aside 10% of the gross rents collected for maintenance on the property. So it's about $155.20 per month on that. And then she is managing the property herself. So we're paying $0 for property management. If you were going to have a property manager here, you can go ahead and put in a 10% or whatever your property manager is charging you and have the property management fee calculated in there as well. And then we walk through what the operating expenses are: property taxes, plus insurance, plus HOA, plus utilities, plus other expenses, 1 and 2, plus the maintenance and property management of the property. And then we show you what those numbers are. And then the total for the month, $373.95. Once we know the operating expenses, we can calculate the net operating income, or the NOI. Net operating income is gross operating income minus the operating expenses. So the gross operating income is $1,552 minus $373.95. That leaves us with $1,178.05 per month left over for kind of paying the financing on the property and our profit. Cap rate is defined as net operating income divided by purchase price. And so we take that net operating income that we just calculated, that $1,178.05, and we divide it by the purchase price, which is $2,500. And so the cap rate on the property that she's buying is a cap rate of about 5.65%. Pretty decent cap rate property. Monthly cash flow, net operating income minus the mortgage payment minus PMI. So the monthly cash flow is 1178.05 minus $1,017.39 minus $158.33 for the PMI. So her monthly cash flow on this property is about break even. It's $2.33 a month. That looks to be about break even to me. And that does include vacancy, maintenance on the property, taxes, insurance, her mortgage payment, her PMI. The only thing it doesn't really include is kind of any capital expenses that you're saving for, and also that she's managing herself. So if she had a property manager, it would also need to be added to that. So the break-even rent that she would need if she was going to be break-even is $1,597.33. She's getting $1,600, so it's very, very close to break-even. So the rent shows you the numbers here. If you wanted to have plus or minus $25 a month cash flow, just does some calculations for you that. Okay, and then kind of clearing up here at the final spot here, there's a spot here for capital expenses. So if you're setting aside money for capital expenses on the property, replacing roofs, redoing kitchens, replacing windows, all the things of that nature, you can do a separate number in here for monthly capital expenditures. In this particular case, she's setting aside 0, which is not realistic, but it kind of is a placeholder. And then the CapEx appreciation rate, you have it here at 3%. And then in order to calculate how much true net equity she would have if she were to sell the property, we ask you, okay, what will your closing costs be when you sell? In this case, we've assumed it's 1% of the transaction. What are your real estate commissions when you're selling? In this case, we've assumed it's 6% of the price that she sells it for. What's the depreciation recapture tax rate? So any depreciation you got from the government when you own the property, you now need to pay depreciation recapture tax when you sell it. And so what is your depreciation recapture tax rate? That's 25%. And then what capital gains tax rate is on the gain. So you bought it for $250,000, you owned it for 5 years, it's now worth, let's say, $300,000. You paid capital gains tax rate on that $50,000 gain. And so what is the tax rate on that? In this case, we use 15%. And so this allows you to find out what actual true net equity you have in the property. And down here just shows you some return quadrants. So I'm not going to go through those on this particular thing. So we're just going through the numbers, but you can go look at those when you kind of add it to your account there. Now we'll go back. Okay, so that was the property. And once you run it here, it kind of gives you a summary. It shows you that cash flow parameter, shows you that it's a dynamic property, shows you that it's a nomad property. We purchased it for $250,000 with 2% appreciation, $1,600 a month rent with 3% appreciation, 3% vacancy, 10% maintenance. You're managing yourself, 0% property management. You're putting 5% down, getting a 360-month mortgage, 30-year mortgage at 3.125%. You're taking your all-in-one account for both the down payment, which is DP, and your closing costs. And then you're doing that all-in-one account for both your income and expenses. And if you want to see any individual property, you can go click on these. I'll kind of just show you here. Oops. So if you want to see any of the properties, you can see all the different charts and everything for those. You can go look at those when you want to, but each individual property has its own set of charts, and then you can see all the properties combined together on one chart as well, if you'd like to. All right. And as I mentioned before, you need to have the property added to the scenario. So if it wasn't added, it would show up here in this red box, and then you have to click on the plus button to make sure it gets added so that it's included in the scenario itself. Because the scenarios, they allow you to use kind of like shared resources. So if you have a property that you want to use in multiple different scenarios, you can make the property once and use those in scenario A or scenario B or scenario C. And so you need to say, hey, which one of these properties do you want to include in this scenario, and which ones do you not want to include? And so these are two examples of scenarios that we're going to be using in other two different properties that we're going to be using in other scenarios that we're not currently using. You can see that these are not included because they're red and they're kind of not included. So the one where we add $100 more per month in rent, and another one where we're getting 10%, paying a 10% property manager, we're going to do those in other episodes for Andrea, but not in episode 1. So they're not included in this scenario. Okay. Now we're on to rules. Rules are things that modify accounts and properties and sometimes other rules. So basically, it allows you to manipulate things and do stuff. So for example, how do we model Andrea's paycheck? So here's her paycheck rule. And if we go in there, you can see that her paycheck, it's the rule. It says paycheck and personal expenses. It's going to run for the entire scenario. This is just a description that we put in here to describe like what it is that we're doing. So you could say this is Andrea's job, and if she got remarried, this is her husband Joey's income or expenses or whatever it is. But you name it whatever you want it to do so that you can keep track of whatever it is on there, or if you're doing it yourself. And then where do we apply this rule? In this case, we're applying it to that scenario where Andrea baseline episode 1. And then what account are we depositing the paycheck to? It's that all-in-one account. What account are we depositing her personal expenses, pulling her personal expenses from? It's that all-in-one account. And then how much is her paycheck? We're saying it's $4,000 a month. And in this case, we're saying once she achieves financial independence, this paycheck will stop. So once we find out that the amount she has in her bank accounts at that safe withdrawal rate and any cash flow she has in from her rental properties, once that actually achieves her goal of financial independence, that $4,000 a month from the passive income, then this paycheck will go away. So the rule is set up that if you toggle this on or off, it determines whether or not you continue getting the paycheck or not. And then her personal expenses, not including the mortgage payment on the property she's living in, is $1,980.54. And then if she was renting a property, you could put aside a number in here to show us how much you would adjust down from when she converts to owning a property from renting. In this case, we're not doing that, so it's 0. And then whether or not we want to have the paycheck, the $4,000 a month, adjust up for inflation over time, and whether or not we want to have the personal expenses also adjust up for inflation over time, you want to click or not click this box. So if you knew you were getting $4,000 a month, but that never increased, it's always $4,000 a month, even if 10 years in the future, then you could leave this unchecked for that. In this case, because $4,000, that's the money from her job at the accounting firm, at the small manufacturing company. She's an accountant there. That money is increasing with inflation, as are her personal expenses. So the personal expenses also increase with inflation. We check this off to do that. And then her tax rate, in this case, on her kind of like income, is 19.65%. So in this case, we're saying her tax rate is 19.65% on the income she's earning. And so the amount of money that she's kind of left over to pay her mortgage and stuff like that is all shown down here. Okay, so that's the rule for her income. Now, she has passive income, so at some point in the future, she's going to receive income from her Social Security. So this one, instead of running for the entire scenario, it runs from a specific date. So we have a rule start date, and then we have a rule end date. And so it starts on January 1st, 2046, and that's when she's going to be 65 years old, approximately. And then her rule end date, it doesn't ever end, so we just kind of leave that blank. Month, day, date, year. Okay, so basically it shows you that it runs forever. So it starts on age 65 for her, and it never ends. And so I just described this as Andrea's Social Security income at age 65. It applies to that scenario, episode 1, Andrea baseline. And we're going to deposit her this passive income into her all-in-one account. And her passive income is going to be about $1,423. So $1,423 per month. And we do adjust this for inflation. And then the tax rate on that income that she's earning is 18.63%. And so we show the amount of money she's earning from her passive income, and that it starts about 25 years in the future, and that will then contribute toward her ability to achieve financial independence. Okay. So we've gone over her paycheck and personal expenses. We've gone over the passive income she has for Social Security. Now we're going to go over a rule to buy properties. And so when we go into this rule, it basically says, okay, run this for the entire scenario. and we're buying nomad properties. We're just describing what it is we're doing with this rule. It applies to that episode 1 Andrea baseline. That's where this rule exists for the scenario. And then which property are we buying? In this case, we're buying that typical rental property that we had there. We're not buying the $100 more per month in rent or the 10% property manager. We're just doing that typical rental property there. And then which account do we want to check for down payment? Because this rule is going to say, buy a property when the account has a down payment. And so what account do we want to check to make sure we have a down payment? Well, it's that all-in-one account that we stored all the money in. And then so that account, we're going to check to see if that's down payment. And we need to have enough for the down payment plus $10,000 because we want to always keep at least $10,000 in that bank account. And we want to make sure that that's adjusted for inflation. So it's not $10,000 10 years in the future. It's $10,000 today plus whatever it inflates at. So we want to keep, $10,000 in today's dollars amount in there. And then how many months of reserves for this property? In this case, she's going to operate a little bit aggressive, and she's going to say, I want no additional months of reserves, just keeping that $10,000 in reserves, and no months for personal expenses, and no minimum months of reserves for other properties. And how many of these properties am I going to buy? Well, in this case, Andrea's saying, look, I want to be able to buy 8 rentals, and I want to have one additional house that I always live in. And so we're going to say buy 9 properties like this. And so she'll be able to buy 9 properties. The last one is the one she's going to permanently live in. The first one she's going to buy, she's going to live there for a year, and then she's going to convert it to a rental. The next one she's going to buy, she's going to move in, live there for a year, and then convert it to a rental. And she's going to repeat that until she gets to buying property 9. And at that point, she's going to live in that property forever. Okay. And then we also check to make sure that she has her debt to income never exceeds 45% DTI. That's a kind of loan rule for being able to qualify for the loan. So if her debt to income buying the next property would be higher than 45% DTI, we're not going to allow her to buy it using this rule. Once it gets to the point where it'll stay, when it's below 45% debt to income, then we'll allow her to buy the next one. So the minimum is a year based on her ability to have the down payment. If she has the down payment within a year and she has her debt to income ratio below that, then after a year, due to the fact that she's moving in and living there for a year, then because it's a nomad property, then after the year, she can then buy another property. But if she doesn't have the down payment, she's not going to be able to buy it. And if she doesn't have the debt to income ratio in order to support that loan, she's not going to be able to buy it. So there it is. And then if she happened to be a real estate agent, she was earning commissions as she bought properties, you can model that as well. In this case, she doesn't have a real estate license, and so she is not modeling how much she has on there, so it's 0 for that. And then we're not using any of this stuff, but you could do like really sophisticated stuff where you say, look, I want to be able to do a cash out refinance on any other properties I own to be able to come up with a down payment in order to buy that property as well. In this case, we're not doing that, and so it doesn't exist there. Okay. So those are the assumptions and the setup for that. Once we get all these assumptions and setup done, make sure it's saved and then click run analysis. And the software will then run your analysis on this particular scenario, and you'll be able to go and see all the different summaries. So it shows you the scenario. She has 2 accounts, the default account and that all-in-one $100,000 account. She bought 9 properties. She has 3 rules in this scenario, 1 for her personal income and expenses, 1 for that Social Security, and 1 for buying properties. She achieves her minimum target monthly income in retirement at 138 months. And if you click on this, it'll show you the chart for when she does that. She achieves her ideal target monthly income in retirement, that $20,000 a month in month 446. She never achieves 2 times her ideal. She has a net worth of $16.22 million in month 480, basically 40 years in the future. Her target monthly income in retirement at the start is $4,000 a month. She's using a 4% safe withdrawal rate. This all starts in April of 2022 when I run this scenario. And the maximum monthly income required for her is $4,216.11 in order to be able to qualify for the loans. So $4,000 of that is coming from her job. And then we need to have $216.11 in order to be able to, from positive cash flow into rental properties in order to get her there. If you want to see a summary of this, you can click on the summary. That will show you just a quick rundown of some really basic charts, but you could really drill down and see a ton more detail as to what's going on. But we won't go into that right now. And then if you want to see some additional reports about return in dollars quadrants and return on equity quadrants and things of that nature, we can do all those to kind of get a feel for that. Okay. But we're not going to do that now either. Then if you want to read the blueprint of the kind of plan all laid out, you can go there, and that has a bunch of reports as well too on the bottom for being able to see stuff. So you can see reports on how risky this particular scenario is, and comparatively, you can kind of look at a lot of details on that too. Okay. So that's it. This has been James Orr. Of course, you can go to the realestatefinancialplanner.com. You can copy Andrea's entire scenario and then just modify it. So if your situation is really similar to Andrea's, except you're not starting with $100,000, you're starting with 200,000 or 30,000 or whatever your number is, and I don't make $4,000 a month, I make $6,000 a month, or I make $2,000 a month. You can change all the assumptions by going in here. Once you copy the entire thing to your account, you can go back through and just as I walk through with the assumptions, just change them to be whatever reality is for you. If you already own several properties, you can add additional properties in there, either already owned or use rules to buy those as well. So that's basically how you work it. This has been James Orr. I hope you enjoyed Inside the Numbers Real Estate Financial Planner Podcast, Episode 1 with Andrea. Thanks, everybody. Bye-bye for now.